Hello, good day everyone. So this is a continuation of our last video. That's lesson one on the rudiments of trading. So today I quickly want to run us through how to read the market candlestick. So like I said, rudiments of trading, the essentials to getting started in trading and how to read the market. So what we're going to look at, we're going to look at, we're going to do a recap of our last lesson, which was a part of the rudiments of trading. We're going to define what a price chart is because we're focusing on price charts. We're going to look at market data, which is volume, market cap, price high, price low, and the last price. We're going to dwell on candlesticks. We're going to talk a lot about candlesticks, and we're also going to look at candlesticks time frame and how to construct a candlestick. Then we'll look at some examples of candlesticks and candlesticks pattern, and we'll conclude. So, okay, I repeated this. In our summary, I'm going to give us some, in our examples of candlesticks, I'm going to give us some extra tips there as well in our summary. So, a recap of last week's lesson. We talked about the requirement for trading, talked about laptop, your mobile device with internet. We talked about what to trade, that people trade digital assets, some people trade forex money, and for we are trading cryptocurrency, which is a new type of asset. And we also talked about why the trading works. What are the things that move price? Economic factors, political factors, natural factors, and so on. Then we went on to talk about where to trade. There's an exchange, the platform for trading. And we gave some examples, and the most common one is Binance. That's for cryptocurrency now, Binance, which is the biggest exchange. There are a lot of other ones. We also talked about some of the features in an exchange, so that when you pick up any exchange or you log onto any exchange, you can play around with it. So some of the features, the major features there are the markets, the order book, the order button, which is the buy and sell button, and the charts. In the last lesson, we dwelled on markets, order, buy and sell button, and the order book. So today we are picking this, the charts or the graph panel. And concluding the last lesson, we talked about the things to consider before you choose your exchange: the security, the liquidity, the fee they charge you for transaction, the minimum withdrawal, and the usability, as well as the reputation of the exchange. Okay, so still on last lesson, a recap. I showed us this graph, and this is an exchange showing us the different features in it. The first one is number one here is your market, which is also known as your market pair. And there are different types of markets. You have BTC market, you have Ethereum market, and so on and so forth. So number two is the buy button, which is where we can place our buy and sell order. And I told us to play with this a lot so that we can get comfortable with it. So number three, which is the charts, that's what we'll be looking at today. And number 4, 5, we combine both together, and we said it is the buy order, where you have the buyers and the sellers queuing up, and you have the amount they want to buy or sell. So today we're looking at this, the price chart. So let's get into it. Definition of a chart. A chart is a visual representation of price action versus time. Price is very key. It's important. It's because of price. That is why we are trading, because there's what they call price action, the movement of price up and down or sideways. So this price action is versus time. It's like a graph of price in the y-axis, then time in the x-axis. So price is in vertical axis, like I just said, and time is in the horizontal axis. So charts can be viewed in different ways. Like we know in school, we have line charts or graph, we have bar charts, and so on and so forth. We have area. We'll see the examples we have, but we'll be zooming in as we'll be concentrating more on the candlestick charts. So chart is the up and down movement of price over time. So types of charts, you have line charts, area charts, bar charts, candlestick chart, which is the most common. And for advanced users, you have Renko. There are a lot of other charts too that we're not going to talk about. So we're going to zoom into the types of chart now. So this is a line chart. Here is the price, here is time. So this chart is just showing you like a graph, like a graph of price versus time. So this is a line chart. This is the area chart. An area chart is like a line chart, but in the area chart you have it painted. Inside is painted, and this is a candlestick chart, and we'll talk more about the candlestick charts. Okay, so there is a bigger picture of the chart I just showed us. This is your price, this is your time. So when you take a chart on your phone or on your laptop, you'll see this moving. It's like a print. The price is being printed as it goes up and down, moving up and down. You see it moving up and down. So this is the time. You can play back and say, oh, I want to check what was the price of this particular asset. We are in this USDT NGN market, that's dollar naira. What was the price at this particular time? You can go back in time and see the price at that particular time, because the graph is showing you the price action, both historical price and the current price. So these price charts, the area price charts, the same but painted. And this is what a candlestick chart looks like, which is the most common chart that traders use. And this will begin to do up. So before that, let's talk about market data. So that when you take an exchange on your phone or website, web-based exchange, when you see some of these data, some of this information, you can make sense out of it. So some of this information or data we have on our charts. Number one, we have the market pair, which we know. For example, in BTC markets, you have BTC USD, BTC Naira, BTC Ethereum, BTC XRP, and so on and so forth. So for this, you are in BTC markets. Under BTC markets, you have different pairs. So you need to know the market you are in, and you can add that particular market you are trading to your favorites. I'll show us what that means. So also the part of the market data is your last traded price. I'll show us. Then you have 24-hour percentage change, which is a percentage change in price in the last 24 hours. You also have 24 hours high, which is the highest price of that asset in that in a particular time frame you've selected. 24-hour low is the lowest price that asset fell to. So you have volume. The volume is the price multiplied by the quantity of the assets that was traded in a day. I mean the repetition here. That was traded in a day. In a day, meaning 24 hours volume. Your volume might be for 24 hours, your volume might be for more than 24 hours, but depending on the particular time frame. But let's look at the charts. Now, this is a screenshot of, beg your pardon, volume generally could be 24 hours. Yes, 24 hours volume. So when it's 24 hours volume, it is your price multiplied by the quantity of the asset that was traded in a day, that's in 24 hours. Okay, so this is a chart, a screenshot from Binance showing us the market. So on Binance, when you're on the website or your tab, your app on the phone, you come to markets, and when you click on markets, it's going to bring out this panel. A lot of buttons are there, but on this panel, the next thing you have to go to is your market. So which market do you want to trade? Now, this shows us that I'm on fiat markets, and in fiat, you have different fiats: Naira, dollar, euro, pounds, they are all fiat. So for instance, if I click on fiat market, I now select the particular coin I want to trade with fiat. So one thing I can also do is to search, use my search button here. And I'm on spot markets. There are different types of markets again. You have spot trade, you have futures trade. You can see Binance even have a zone. There's another button, I think ETF. So I'll show us on a live chat. So I'm on fiat. I can type and search for the particular coin I want. Then I can add that particular market I'm trading to my favorites. All I need to do is to click on that star, and it's going to highlight. And when you click on favorites, you will see all those coins that you want to trade. You will see them added to your favorites. So just to recap, the market data again, this is it. This is the market pair. This is your last price. Now the last price is the last price that particular asset was traded. So for this market, BTC was traded for $34,036. Forget about the points. So this is the 24-hour change. Remember we said 24-hour change is the percentage change in price in the last 24 hours. So in the last 24 hours, the BTC price fell by 6.8%. It fell, it dropped. That's why it is negative, and that is why it is in red. And this is 24 hours high. 24 hours high, it means the highest point the price got to, the highest point. 24 hours low, it is the lowest point the price fell to. Now this is your market cap. The market cap is the volume of that asset, this asset, the volume of that asset multiplied by the price. So it's just like saying you sell shoes. If you sell shoes, for instance, how many shoes did you sell? Do you sell in a day? So let's say you sell 10 shoes, 10 pair of shoes in a day. How much is one shoe? So you multiply the price of one shoe by the total number of shoes that you sold for that particular day. So that will give you your 24-hour volume. So for BTC here, next let's look at elements of candlestick. Like we know, candles, they light up darkness in the house. When there's no light and you light up a candle, you can see. They help us to see, but it's not very bright. You can't compare a candle light to a NEPA light or to a torchlight. So with Japanese candlestick, we can see through the market and have a sense of market possible direction. A sense of market possible direction. It's a statement of probability. We are not certain about it. So the more candles we light up, the more we brighten our dark places. Just like this. One candle compared to 10 candles, the brightness is different. The brightness of 10 candles or 20 candles is more than just one candle. So that is to say, the more candlestick we understand, the better our understanding of the market. So, continuation of elements of candlestick. Now, this is what a candlestick looks like. Each bar is composed of 4 elements. The open price, which is the starting point of the price. The highest price, the highest point the price reached. Now, we also have the low price or lowest price. The low price, this point, is the lowest point the price reached. Then we have the closing price, which is the ending point the price reached. We'll understand it better as we go on. So, I think I should use the white. Okay, so elements of candlestick. Each candlestick is composed of 4 elements. The open, which is the starting point of price. The high, which is the highest point the price has reached. The low, which is the lowest point the price has reached. And the close, which is the end point the price has reached. So for demonstration, let me grab my screen with screenshots, then show us. So, okay, before that, the candlestick is composed of the candle body and the color. So there's the body of a candle. The color could be green or red. Now it's green when the closing price is higher than the opening price. What is the closing price and what is the opening price? Remember, here we said the candle has 4 elements. I would rather say 4 price elements. So the 4 price elements are the open price, which is the starting point of the price, the lowest price, the lowest point the price has reached, the highest price, which is this, the highest point the price has reached, then the closing price, which is this. So those are 4 price elements of a candlestick. Now, when the opening price, when the closing price, which is this, when it is higher than the opening price, you have a green candle. Okay, so this is the opening price, and this is the close price. So when our closing price is higher than the opening price, within a given period of time, we say we have a green candle. Okay, and another word for a green candle is a bullish candle, and that signifies a gain. So On the contrary, we have a red candle when the opening price, which is this, is lower than the close price. Opening price, which is this, is lower than the close price. Then we say it is a red candle or a bearish candle. That it signifies a loss. Now sometimes they use green, they use white or green or any light color to signify this bullish candle, and sometimes they use black or any dark color to signify the red candle. Okay, so let me just go through it again. You have, this is the opening price and this is the lowest price. Price went down here, then it went up higher, then it came down and closed here. So opening price is higher than the closing price. You have a green candle. But when it is the other way around, this is the opening and this is the close. So you have a red candle. Okay. Now we have other elements of candle, which is the candle wick. Now candle wick is the upper part, the like the thread. Sometimes they call it shadow, candle shadow. The candle wick, you have upper candle wick and you have the lower candle wick. Okay, and the candle wick is the highest point the price has reached for the upper candle wick, while the lower candle wick is the lowest point the price has reached within a given period of time. All right, I've explained the color. The color could be red or green. It is red when it is bearish and it is green when it is bullish. Bullish means gain in price and bearish means loss in price. All right, so we move to the next slide. Still talking about the elements of candle. This is what I showed us in the last slide. Okay, so this is your green candle and this is your red candle shown in the last slide. Now in this slide, let's just see how to tell the story of this candlestick. Don't forget that this is your price chart and this is your time. Okay, so price, and don't forget there's increase in price, you know, from year to year means increase in price, and this is increase in time. So now let's look at this. The price opened from here, that is the price started here. It fell, went down, the low point, then it rose to as high as this level and it came down to close here. Okay, so when we draw this, we draw it like this. This is the open and price went down. When it went down, it came up again. Okay, went up to this level, then it came here to close. So open and close, we have the body of a candle. In the previous slide, I don't know if I mentioned it, but a candle has a body and wick. You know, you have the body, this is the body, and you have the wick of the candle. The wick of the candle, yeah, I mentioned it. The wick of the candle is the lowest part of the candle and the highest part of the candle. Okay, so for this, we are going to have a green candle. It should be a green candle because okay, it should be a green candle. I can't paint it green, but that should be a green candle. So if it's where, if this was the opening price and this was the closing price, it's going to give us a red candle. Okay. Now, green and red is the conventional color to use for candlestick. In days past, and even nowadays, people use white and black as well. But you can decide to use any color you like, you prefer. For me, I use other colors other than green and red. Now, I believe with that, we've understood what a candlestick is. Candlestick, you have the body and you have the wick, and all these are just price points of price. This is the opening price and this is the close price, and this is the highest price and this is the lowest price. So your candle body is just representing your close and open, while the wick is representing the highest price and the lowest price. Okay, now when the opening price is higher than the closing price, opening price is higher than the closing price, you have a bearish candle, a red candle. Now when the closing price is higher than the opening price, closing price higher than opening price, you have a bullish candle. Okay, now this shows us how the candle is being drawn. Okay, this is the open and price fell down to here, it came up again and it closes here. So the closing price is higher than the opening price, and that gives us a green candle. All right, so let's quickly move to candlestick time frame. Price chart can be viewed in different time frame. There are high time frame and there are lower time frame. Example of time, as we know it, time is being calculated in minutes, in hours, in days, in weeks, and in months. So common time frames that we have is the 15 minutes time frame. The 15 minutes time frame is your lower time frame. This is a lower time frame. LTF means lower time frame. HTF means higher time frame. Now, 1 hour and 4 hours are also lower time frame. Okay, 1 hour and 4 hours are also lower time frame. Anything above 1 day is an higher time frame. Anything above 1 day is an higher time frame. Oh, anything above 1 day is higher time frame. So meaning 1 day, 3 days, 1 day, 3 days, 1 week, 1 month, those are higher time frame. Now, time frame is very important because it's going to help in your analysis. Now, still on time frame, candlestick time frame and trading style. Now, the the way you trade is going to, the time frame you trade is going, it's dependent on your trading style. And knowing the time frame to base your trade on is so important in determining the success of your market interpretation. Because there are different time frames. I'll show us in the chart now. There are different time frames. So when you want to trade, you want to take a trade, you need to work on a particular time frame. So how do you know a particular time frame you have to base your market analysis on? So base your trade on multiple time frame with a time division of 4 or 3. For instance, 1 hour candlestick is equal to 4 15-minute candles. Okay, that's just saying in 1 hour you have 4 15 minutes. So that's why it's a good practice to base your trade on time division of 4 or 3. We'll see that. Now we need to know what is scalper, who a scalper is, and who a day trader is, and who a swing trader is, and who a long-term trader or investor is. You might fall within this group, either a scalper or a day trader or a swing trader. Now, a scalper is someone who they execute a lot of trades in a day. They trade on the 1 minute, 5 minutes, and at most 15 minutes time frame. Okay, so a scalper trade on a very low time frame. As a day trader focuses on 15 minutes, 1 hour, and at most 4-hour candlestick. A day trader also trade on low time frame. Now, these two, the scalper and the day trader, they are known as short-term traders. Okay, they are known as short-term traders. Short-term traders. Why these two guys, the swing trader and the long-term trader, like an investor, they are known as the long-term traders. Long-term traders. So if you're a scalper, you're trading on 1 minute, 5 minutes, and 15 minutes, means those are the time frame you watch. Those are the time frame in which you monitor the market. So you look at 1 hour, you look at 5 minutes, and you look at 15 minutes to take the market decision. Now for the day traders, they look at the 15 minutes, they look at the 1 hour, and they look at the 4-hour candlestick. For swing trader, they look at the 4-hour candlestick, 1 day and 1 week. While the long-term trader, they focus on weekly and monthly. Now, you need to know where you fall between these 4 categories of traders. Candle closes are very important in market direction. Remember, we talked about candlestick, we talked about the open price, the close price, the low price, and the high price. So candle closes are very, very important to decipher the market's direction. Okay, so let's quickly look at the charts to explain these different time frames before we talk about candle construction. So this is let's go to our charts. Now this website I'm using or web application is TradingView. It's a chart for analyzing the market, for doing your technical analysis. Now, every exchange on either mobile phone or website has trading view or has a charting tool integrated into it. So for Binance, for instance, a you will see Binance, you will see a chart for analyzing the market. This is Binance. So when you go to let's say you go to trade on Binance, you click on trade, and you click on trade, you see, I go to advanced. So it's going to bring the chart for me. So every exchange, whatever exchange you are using, they have a chart integrated into it. However, you cannot do detailed technical analysis on them. This is line, so I can take it to candlestick. Take it to candlestick. You can do a detailed technical analysis on it because it's too small, because they have other panels in it, so it is small compared to trading view. Trading view is simply for making market analysis. However, there are ways you can also take trades on trading view, but it's primarily meant for market analysis, so you can see your candles speak very well. Okay, so let me go back to trading view. This is just to show us that an exchange has trading view integrated into it. You see, trading view is integrated into Binance. However, Binance has their own charts. This is Binance own charts. It does not have a lot of tools for you to annotate and do market analysis. But if you come to trading view, so trading view has a lot of tools, All these are tools that you can use to analyze the market. We can learn that in another lesson. But for now, I just want to show us that in the exchange you are using, they have a charting, they have trading view as their charts software, if I would say so, integrated into the exchange. So this is BTC USD market. So I'm in a 4 hours candlestick. So 4 hours candlestick, this tells me that each candle, for instance, I pick this candle, any candle, you pick this candle, you pick any candle, you pick this candle, you see, it has a close. I'm on a green candle now. So this is the open, it opened here. This is the lowest. I hope we can see this. This is the lowest and this is the highest point. Okay, let me try to zoom. So, okay, I've zoomed in so we can see it clearly. All right, so this is one candle, and this candle represents 4 hours. That this candle shows you the price action within 4 hours. Okay, and the candle opened here. Since it's a green candle, it opened here and it went down the lowest point. It rose as high as this point and it came back here to close. Okay, so all these represent price. You can just draw this. You see the price here. This one, you see the price. This candle, they represent price action. So for the red candle, this candle opened here. It went as high as this, then it came down, it fell, it went to this level, and it came up again to close. Okay, so I can, now if I'm doing day trading, I base my trade on 3 time frames. I monitor the market on, especially, I take decisions on 4 hour, but I look at the daily candle, which gives me a broader eye view of the market direction. But I take my decision on 4 hour, then I can do some monitoring on 1 hour as a day trader. So, but for swing traders are those who, day traders, you want to open and close your trade within 24 hours in that particular day. You want to make your profits that particular day and close your trade. But if you are swing trading, you could open your trade and leave it for like 2-3 days and maybe 1 week. So that's why for swing traders, you take decision on the daily, but you look at the weekly candle and you also look at the 4 hour candle. Okay, so you see it's just for day trader 1, 2, 3. Now for swing trader 1, 2, 3. Now for long-term trader, you just look at these 2. Why for scalpers, you look at these 2. 1 minute, 5 minutes, and 15 minutes. So you can change the time frames. Okay, so let's go back to our PowerPoint. Now, candlestick construction. Candlestick construction is just to show us how the candlestick is being constructed. There's a video on investors on the ground, their second lesson on trading for the basic class. They really demonstrated how to construct a candle, like 1, 2, 3, 4, 5, 6. These are 6 candles. These 6 candles. These 6 candles is what gives you this single one candle. Okay, so 1, 2, 3, 4, 5, 6 gives you this single candle. Now, how is that possible? It's This is the opening price. This is the opening price. The price opened here. It went down. Price went down as far as this. It was still moving, moving. It went as high as this. Then it came back here to close. Okay, so it means when I want to draw my candle, I draw my candle as, okay, this is the opening price. And it went as high as this, but it came down here. Let me do that again. This is the opening price. Here is the opening price. Okay, and the price fell as low as this point. It came back, went as high as this point, then it came here to close. Okay, so that is the price action within the specific time. So here is going to have a wick, and here is going to have a wick, and it's a green candle. So that's how to construct candle. This four candle, this six candle, maybe this different time frame, lower time frame, and if I zoom out to a higher time frame, I have just one single candle. So this is the same thing. This explains the same thing, how to construct a candle. The price opened here, it went down, closed here. But for this, it opened here, came down, and closed here. So this is for different time. If I want to fix it for one single time, then it's going to, this is the close. So this is your close price, and this is your opening price. Then it's going to have wick. This is a long wick, and this is a short wick. It's long because, you know, this is where it rose to this point, but from here, it fell down again to close here. So you have that kind of candle. So we can play with that. We have different examples to play with. This is also saying the same thing. The candle opens here. It opens here, went as high as this, fell back. That's for one candle. Now the second one, it opened here, fell here, went as high as it, then came back here to close. So this one, when you interpose it well, it will give you just this candle. So the same thing here too. We can play with that on our own on how to construct candlestick. Just know that this, when you are looking at higher time frame, inside one candle, you could have, when you go down to your lower time frame, inside one candle, you could have several candles. Okay, so it's just the time frame that is giving you those differences. All right, so let's look at examples of candlestick shape. It's also called pattern, but for me, I prefer to call it shape because it's like a micro picture of the candlestick. You're looking at each individual candle. Okay, so it's a micro picture. You're zooming in into a single candle. This picture is just to explain something for us. Zoom in and zoom out. This is a watermelon, and when you zoom in, you use your microscope to view it. This is what you have. The same thing is a babish, like a bird eye view. This is like a bird eye view, or you're viewing it from an aeroplane. Now, when you go inside the beach water, now you see, you can see waves, but you can't see waves or shark from the aeroplane because it's far. You are having a broader view of the image. So zooming in, look at this as well. When you zoom in, you have these kids here playing, but when you zoom in, you can now see them. Well, so that's just explaining what zooming in and zooming out is. So I made this picture because we need to understand this terminology. Zoom in. So when you are looking at an individual candle, one candlestick, you're like zooming in. You're checking the micro picture of the candle. But when you are looking at the broader picture of it, you are zooming out. You are looking at the pattern. The next slide will show us that. So examples of candle. Now, individual candles. You have a lot of candles. Engulfing, you have the one they call engulfing, you have the one they call Ama, the one they call Doji, the one they call Tweezers, and many others. But I just listed only these four for us as an example. Okay, so this these are the examples of candles. You can get these charts from babypips.com. Babypips.com. It's the forex website where you can learn forex from. I know there's a similarity between forex and crypto in terms of technical analysis. So this chart is gotten from that website. You can get the chart from there, and I hope it's clear. So here we have numbers of bars. The bar here is talking about the candle and the name of the candlestick, then the direction of the market from the type of candle. Okay, the name of the candlestick is not as important as the shape, so it is the shape or the pattern of the candlestick you should master. What I do is I print these different candlestick shape. I print them and put it by my side or paste it on my wall so that when I look at the market and I look at this chart, I can understand what the direction of the market is saying. So for this, when you see a candle form like this, it's telling you that the market is neutral. White here is also same as green, and black here is also same as red. Now this is a spinning top, and when you have two candles like this, it's telling you the market is neutral, that is going sideways. A neutral market, what does it mean? This is downward trend, this is an upward trend, but you can have something like this, something like the market is ranging, just within a range, just within a range. You see, that's a range. So this is the top of the range, and this is the lower part of the range. So the market is within a range. Unlike this, the market is going up, trending upward. Unlike this, the market is trending downward. So this is a downward trend, and this is an upward trend. But this, when the market is just going up and down, bouncing up and down within a range, you say the market is trending or it's neutral. So this candlestick pattern um, signifies a ranging market, a neutral market. Let me put this so that we can just take it. All right. So when we have a doji, also this kind of candle, the body is very tiny and it has a long wick on both sides. It also means the market is neutral. Now, when you have this, it means a bullish market. Of course, a green candle means a bullish market. A red candle or a black candle means a bearish market. Now, armor. This is an armor, and is one of the important candlestick to know. An armor, you have a downward trend, then you have an armor forming, and after an armor, what you are expecting next is a bullish trend, an upward trend. Okay, you have a downward trend, then you have the armor formed, then what you're expecting next is a bullish trend, an upward trend. So that is armor. This is it here as well. This is a downward trend, then this is the formation of the armor candle, then what you're expecting next is an upward trend. Okay, so this armor, you can also have it, for this, you have a downward trend first, the armor formation, then an upward trend. Now for this, you have a upward trend, then the formation of the armor at the peak of the upward trend. Then the next thing that signifies is a downward trend. Now this is different from this. This is an armor that is forming at the peak of the market. But this is an armor that is forming at the base of the market, So there are two different things. But this armor is called an armor. Why this one is called a hanging man? It's an hanging man, like somebody wants to fall. Somebody hanging on the tree and he wants to fall. So the price is hanging, and the hanging man there, which is the armor, is telling us that the price is going to fall. Now, inverted armor. The inverted armor is, you have a downward trend, then you have this inverted armor. So what it's telling us is that the price is going to go up. Now, a shooting star. Still, all these are just types of armor, but in different market condition. Now, a shooting star implies a bearish market. Okay, price is trending upward, then you have the formation of the shooting star, then the next thing is a downward trend. So look at the similarity, look at the contrast here. This armor, the armor formed after a downward trend signifies an upward trend. The armor candlestick formed after an upward trend signifies a downward trend. Then an inverted armor formed after a downward trend signifies an upward trend. An inverted armor formed after an upward trend signifies a downward trend. So all these things take time to understand. You just stare at it and watch it. So this is for single candle formation. Now for double candle formation, you have for double candle formation, we have bullish engulfing candle, you have bearish engulfing candle. Engulfing means you have a candlestick formed, maybe it could be red, a candlestick formed, let's say a red candlestick, which is this black one, and the next candlestick that formed engulfed it, that is, it covered it. That's the meaning of engulf. It covers, it's covering it. It's covering it. Not so perfect. So this, if it's a downward trend, you have a downward trend, then you have the formation. For this, we're taking into consideration the two candles here. So we have an engulfing, a bullish candle engulfing the previous bearish candle. So that signifies an upward trend. On the contrary, if it's an upward trend, then you have your bearish candle engulfing the previous bullish candle. Then that tells you that the price should go down. Okay, so this is a tweezer. This is how it looks. This is a tweezer bottom. This is how it looks. This is a morning star. A morning star. This is how it looks. A evening star. This is how it looks. We're considering a double candle here. Double candles. These two candles. Now you can also consider triple candle as well. These are three white soldiers, and these three black crowns is inside. The candles are a lot, there are many, and even me, I don't know all of them. But what I do, like I said, I just print the chart and paste it on my wall, and I look at them and look at the markets. Okay, so that's all for examples of candlesticks shape or candlestick formation. You can get these from this website. This site, babypeeps.com, is a forex website. So you can get the chart from there and familiarize yourself with it. So still on candlestick chart, but this time around we are zooming out into the candle now. Remember here we are just looking at individual candles, but now we are looking at the candle as a whole, the market condition as a whole from the candlestick. Now for this, you're zooming out. We're zooming out. And this is what zooming out means. It means you are looking at a bird eye view, bird eye view, bird eye view of the market. Unlike this was what we were doing in the previous slide, looking at individual candlestick. But now we're looking at the broader view of the market, the macro or the big picture. Okay, so we have examples, we have different names, we have a lot of them. You just have to familiarize yourself with them. It's going to take time and it's going to take practice and it's going to take constant monitoring. You know, a lot of screen time with your screen on the computer before you can get used to this different candlestick pattern. So we have a bullish top, we have inverted, we have a double top, which is a bearish signal. We have an inverted double top, which is a bullish signal. It gives you a bullish sign. We have head and shoulders, is a bearish sign. We have inverted head and shoulders, a bullish sign. We have rising wedge or rising triangle, which is a bearish sign. We have falling wedge, which is a bullish sign. There are other candlestick patterns that we also need to know. These are just examples. So we do ourselves good to just Google the charts and get used to those charts. Now, let's go to the live chat and let me explain these patterns for us before we come back to this. Now, assuming I'm doing day trading, so I'm going to be trading on 1 hour, 4 hour, and a daily candle. Now, what am I going to do? I look at the 4-hour candlestick and have, or rather, I look at the daily candlestick and have a broader view of the market. Having a broader view of the market so that I can see the market clearly. You know, the farther you see, the farther you see, the farther you go. So this is a pattern. For instance, this is a pattern. It goes like this, came down here, went like this again, and it came down here. Now, from this pattern, if you ask me, I'll say at a point in time, price is going to drop to this level because this is a particular candlestick formation, up, down, up, down. And when we come to our slides, this is double top. See, double top. That's what we have here, double top. Now, a double top candlestick pattern, tells me that price is going down. Now, there are some basic things we need to know, which is support and resistance line. This line we're seeing here. Let me go back to the live chat and just explain to us what support and resistance is. I need to explain what support and resistance is. Okay, I want to explain support and resistance. Okay. Support and resistance line. They are very important in understanding the market. Support and resistance line. There is also known as SR. S for support, R for resistance. Now, when you're analyzing the market moves in different directions. Okay, market does not just go up, 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 up. No, it goes up, down, up again, down. It will go up, down. It will fall down like this. You know, that's how the market moves. Whatever goes up surely comes down. That's how the price. When I say market, I mean the price. That's how it's moving. Okay, it will drop like this. Now, from this, when I look at this, there is a trying to change the color. There is a particular line I will notice that at every point in time the price reach that line, it's falling back. That is called a resistance line. At every point in time the market reaches that line, the price falls back. So the resistance line is acting as a roof, okay, or as a ceiling rather. ceiling, because it's making price to fall back. Okay, so on the other way, on the flip side, I have a support line. I notice at every point in time, price gets to the lower, gets to a particular line or a particular level, the price bounces up. Price bounces up. It got to this part, it bounced up, came back again, it bounced up. So that is support. That line is supporting the price from falling. No, something is supporting the price from falling below a particular level. So that is called support line. It's supporting the price from falling, just as if something is holding the price from falling back. Okay, so that's support and resistance. Now trend line. You can draw your trend line by just drawing a line following the market trend. Okay, so that's just by the way to understand support and resistance. Let's go back to our charts. Let's go back to our charts. So this line here, this blue line is a neckline. Okay, so all these are just drawing the price action. Okay, so price moves up. We see the price went up like this, came back. There was a line supporting it here. It went up again. It fell back. So it means there's even a resistant line here. There's a resistant line. There's a line there, like a resistance. The price fell back. So if I see this, if I see something like this kind of pattern, if I see a double top means this is one top, this is another top, double top. So if I see a double top, price is coming, trending upward, it hits here, it fell back, went up again, hits here, and it fell back. So even before falling, once I have this line, I draw this my neckline. This is my support line. I can anticipate from here that the price will get to this point here. That is double top, and this we can see in the live charts. I'll go to the live charts. I'm sure it's in live charts. So this is a live chart. Let me use the tool here. So this is a line. This is a trend line. That's a trend line that I've drawn. Now, though it's not perfect, just for example. I notice price got here and price fell. Okay, price fell. After falling, price still went up again. Went up again to this point, and it fell back. Now, all these lines are not perfect, okay? But I can see a double top. This is a double top. This is one top. This is another top, although not perfect. But this now tells me at a point in time, I will have something like this. I will have something coming down to this level, down to this level, down to this level. So at a point in time, Bitcoin is going to get back to 22,000. When that is going to happen, I can't say, but from this chart, from this technical analysis now that I've just done, following candlestick patterns, I can say that the price is going to, at a point in time, price is going to get to 22,000 or 23,000 or 20 something thousand. Okay, so it's not always perfect and does not always follow so. So it's not a actual science. It doesn't always follow. Okay, so that's double top that I've just explained. Now I need to put resistance line. Support line that I just explained for us. This is a support line. This is a support line. You can put it here. So you see, price gets it, goes up, gets it, goes up, gets it, goes up again. So that's the support line I just explained for us. Okay, so back to our chart. Now, understanding these candlestick patterns are important. Okay, these candlestick patterns and every other thing in technical analysis, they are not actual science. They don't give you the actual thing, but they just give you an idea. So it's a probability. It's something that it's a probability that this will happen over. There's an higher probability that this will happen over this. So it's not that it's an actual science. Oh, you've seen a double top, then price is going down like this. No, it's probability. Just that the chance for that thing you've analyzed to happen is higher than someone who doesn't even understand technical analysis and does not analyze markets. Okay, so there are different types of candlestick pattern. This double top. This is a head and shoulder, like human head and shoulder. Okay. This is the this is the head. and this is the shoulder to shoulder. So when you see head and shoulder in the market, you get your support line, which is the neckline. Then you can now project that the price will go back to this level. Okay, so this is a bearish rising wedge, bearish expanding triangle. This can also be called a bearish rising triangle. It is bearish rising rectangle triangle, bearish expanding triangle, just the opposite of this. Now this green line, they are projections of where price could get to. So that's why this chart is good. Okay, when you see these charts, you can take some decisions on it. All right. So we need to spend time on these charts to understand them. Okay, so candlestick patterns and their signals. We won't look at all of them. We'll just pick a few candlesticks. I've given an example of a bearish double top. I'm going to give example here of an inverted head and shoulder. Maybe I should just run through this. Let me run through this. I've explained this. Now for head and shoulder, just like I did for the bearish double top, you can also do for the head and shoulder. I'll do one more examples, maybe with a different pattern, candlestick pattern, so that we'll get the picture clearly. So this bearish triple top. Triple top means one, this is two, and this is three. So triple top. Now this is also same as this, but now in the opposite direction. So it is an inverted. It's a bullish double bottom. It's an inverted double top. Okay, but now it's called double bottom. Now the same thing. You have the opposite of this. The opposite of a bearish head and shoulder is a bullish inverted head and shoulder. Okay. Now it's bearish. The name bearish is coming from the direction of the market, the projected direction of the market. That's why it is bearish. Price is going down. It is bearish. Price is going down. It is bearish. Price is going down. It is bearish. So what you have down here is just the opposite of what you have up here. All these are just the opposite of what you have up here. So the opposite of a bearish double top is a bullish double bottom. Opposite of a bearish head and shoulder is a bullish inverted head and shoulder. It is inverted. Okay, like a mirror image of this. So the opposite of a bearish rising wedge is a bullish falling wedge. This is rising and this is falling. And this shows you the projected or the anticipated price direction. Okay, so the opposite of a bearish expanding triangle is a bullish expanding triangle. The opposite of a bearish triple top is a bullish triple bottom. So it's that, shall I say it's that simple? But that's how it could be. I could explain it. So we master these charts by constant viewing of it and constant viewing of the market. So let's go to the market before. Okay, let me explain this first. Now in this slide, I showing us, if we could remember, an inverted head and shoulder. Inverted head and shoulder is something like this. Price went up, price fell, price went up again, fell down. Now when you see this, then you can now say, oh, I'm having a candle, a good pattern. So from this, I have my resistance. This is also my support. Then I can say, oh, if the price, I can now say, if price gets to this level, I'm going to buy. I'm going to place my buy order here at this point because I'm anticipating that the price is going to move up. Okay, so that's how we enter and exit the market. So when you want to, if this is a market now, you want to enter it. I have this pattern as formed. I've seen this. I've identified this pattern. So after identifying this pattern, this is the previous market price. It hasn't gone yet, but I've identified this pattern. I can now say, oh, I'm anticipating that the price is going to break this resistance line. And once it breaks this resistance line, a break of resistance line or a break of any support line is when that candle closes above that line. So this is a resistance line. So once this candle closes above, now we know what a candle close is from the previous slide. Now once this candle closes above this, that's if I have a candlestick forming like this, candle formed like this, that is a candle close. I may have a line like this. I may have another one like this. Okay, so this is a candle close above that resistance line, because don't forget, This candle has, so now I can say this candle has broken this line, this line. So once I have that break, then I can place a buy order. I can now say, oh, I'm going to place my buy order here. I'm going to buy here. Let me use the green for buy, green for buy. All right, so I'm placing my buy order. I don't know if it's clear. It's not clear. Okay, so my buy, I'm buying here. This is where I put my buy order at this line. Then I can make projection that, oh, I'm going to put my, since I'm projecting, I'm making a projection that price should go like this. Making projection that price should go like this. Then I can use this point to gauge my sell order. I can use that point to gauge my sell order. Put my sell order here. Sell order. Okay. Now, this I just demonstrated is what is here. This is a downward trend. This is a downward trend. Price went up a bit. It came down. Went up again. Came down. I have an head. This is the head. This is the shoulder. The head is lower than the shoulder. Okay. And price came down again. Oh, I can now say, just like here, I identified this half before the market broke this neckline. This neckline is referring to the resistance. So I can now say, oh, price is coming up. I can say the price is coming up and anticipate that price is going to break this support line and move higher. Okay, so that's what we have here now. In this is the shoulder, this is the head. Now the price broke the line, the neckline, which is the resistance line, and we see price move higher. Now there's something interesting in this chart, and that is this chart use the distance between this neckline to fix its take profits, its sell order. That is, you want to project where your sell order is going to be. You know, here I use the distance between here and here to put my sell order. Okay. However, from here you can use the distance between this resistance and this point, this distance, to fix your sell order. Okay. All right. So I'll go to the live chat now and make an explanation, a demonstration on a demonstration before we wrap this up. There's maybe in another lesson we can look into this candlestick into detail and the candlestick pattern to explain the different patterns and how to use them to enter and exit a trade. But this video is just to explain the concept and the importance of candlestick for us so that we can appreciate it. So I come to my 4 hour. I look at the market. I can see a pattern already. I can see a pattern. Though in hindsight, this is a previous market price. So let's look at this for instance. Market came down. Let me use the white. Market came down, touched this line, went up, came down. Don't forget, I told you it's not as perfect as it is in textbook or as it is in the chart I showed us. You know, it went up again. Now, this is a double bottom or an inverted double top. But yeah, the price did not reach this level. You know, in the textbook or in the picture I just showed us, the price got to this level before it went up. But in real life situation, our price didn't do so. See where it got to. But for me, even when I see this, I can still tell that, oh, once price broke this point, broke this level, once price, I can tell that once price broke this level, which it did here with this candle, this particular green candle. So once price broke that level, I can tell that price is going to go up to this level. And that's what happened here. So that's double bottom. Let's look for something else. Can we have an head and shoulder? It's good to always use high time frame when doing your market analysis. I will explain this. Okay. This is in a way I have is this is this or coming from here. This this this. This is like a double top, double top, but it's not perfect. So that's one thing that we are going to be encountering when we start analyzing the markets. You're not going to see a perfect pattern like the way it is in the textbook. Textbook, I mean, the picture I've shown us because these things are from textbook. So we're not going to see something that is as perfect as that. You just have to use intuition and say, oh, I've seen this. And when you keep studying these things, it's going to be a second nature. It's going to be a second nature. So we need to spend more time studying it. Okay, so let me just summarize here. We can play with those different candlesticks on our own. So to summarize, candlestick chart is key. It's important. It's an important. Sorry, yes, candlestick chart is an important part of an exchange. Remember, I showed us Binance and told us that every exchange has a candlestick chart integrated into it. This is Binance. It is the exchange. So what you can do on TradingView, you can also do it on Binance. These things can also be done on the mobile version too. Of course, visualization for clarity purposes is good to visualize on laptop or on desktop. If you really want to do technical analysis, you do it on laptop or on desktop. But if you don't necessarily need to do a very rigorous technical analysis before you can trade well. You can use your phone. Sometimes I analyze on laptop, then I view it on my phone. Sometimes you can just take your phone and do some drawing on the phone too. You can do some of these things on the phone too. So, but if you really want to do technical analysis, you have to do it on laptop or on desktop. So we are saying exchanges has the candlestick charts, okay, and it's a very important aspect in an exchange. The candlestick chart gives light to see what the market is saying. It helps to understand the potential direction of the markets. Like they will say, it helps you to predict the market direction, but without precision. Without precision, just like you saw a double top chart I showed to us, when we got to real life situation in the market, it wasn't as perfect as that. So that's one thing we should know. These things we won't see them perfectly. It won't be perfect, but with time you'll be able to correlate what you have in real life and what you have in the textbook. So we need to spend time to study these charts. Candlestick OHLC, which is open high and low, open high, low, and close price, especially the closing price, gives a candle its different shape pattern. Okay, so it is the price action, the open price, the high price, the low price, and the closing price that determine the kind of shape a particular candle is going to take. Candlesticks can be viewed in different time frames. So when you're trading, use at least two time frame, one high, one low. Different traders focus on different candlestick time frame. Short-term traders focus on low time frame. Long-term traders focus on high time frame. So you need to know where you fall into, a long-term trader or a short-term trader, and tailor your expectations accordingly. Tailor your expectation accordingly means if you're, for instance, I'm analyzing, let me say 5 minutes candlestick charts. 5 minutes candlestick chart means what I've analyzed and my expectation or my projection of the market is going to manifest in maybe in the next 15 minutes or in the next 30 minutes or in the next 40 minutes or 1 hour. Okay, compared to someone who is analyzing the market in a daily candlestick chart. If you're analyzing the market on a daily candlestick chart, your expectation or projection is going to manifest in a day or 2 days or 3 days time, or even maybe 5 days time. So when you watch the market and see what the market is doing, the time frame you're using to analyze the market, to check the market, you need to tailor your expectations accordingly. So higher time frames are important than lower time frame. Even if you are trading low time frame, it's always good for you to view the high time frame so you can have a better eye view of the market direction. Those who see far go far. So mastering candlestick shape and pattern takes practice and time. When you spend a lot of time on these things, it becomes your second nature. So that's all we have for candlestick, and this is just an introduction to it. We can dive deeper into candlestick later, but this is just an introduction to it. All right, thank you very much. And if there's any question, we'll post it in the chats in our chat group, or when we meet again for live section. Thanks. Bye.